And welcome to the ETF Edge portion of Halftime. I'm Bob Pisani. Two of the hottest trends in ETFs are cooling off a bit. Buying protection against a downturn in the market was the hot ETF trend of 2022 and into 2023. Investors owned stocks, but also sold calls that would collect income and provide a cushion against any downturn. But the market's been rising all year. Most of these strategies are underperforming. Another hot trend, buying the international market over the U.S. market, also underperforming this year. What's going on? Let's talk with Kim Arthur. He's the CEO of Main Management. Kim, the big ETF winner last year was JEPI, that JP Morgan Equity Premium ETF, $27 billion in assets. And you run the competitor there, the Main Buy-Write ETF, but they do similar things. They own stocks or stock indexes. They sell calls against them, but both of them are underperforming this year. When you're selling calls, you bet the market's going to remain range-bound or lower, and yet money keeps going into these funds. People still want protection even in an up market. Explain this. Why is this working and not working at the same time?
Yeah, sure, Bob. Great to see you. Thanks for having us on. Yeah, call writing works in 2 out of 3 environments very well. It'll outperform typically in down markets, like you mentioned in 2022. In a flat market, it will typically outperform because of the premium income. But in a straight up market, it is going to struggle for sure. And as you mentioned, you've got JEPI that's actually also faced a couple other issues where the beginning of the year, they were distributing an annualized rate of almost 13%. That's now down to about 8% because the volatility index, the VIX, has collapsed. So I think it's also a positioning situation, Bob. We like to look at our buy-write and tell people that it's the glue between the wall, which is fixed income, and that's investment grade, and the wallpaper, which is equities, which is, obviously more risk on, and that it should live somewhere between that, and that you have to make sure you position it properly in a client portfolio.
Yeah, I want to talk about this a little bit more on the ETF Edge show, but I want to turn to international because that's the other thing that's not worked this year. It started out promising. Everyone was in European and emerging markets. They outperformed the U.S. early on, but it's all faded. The U.S. is far outperforming Europe, most of the Far East, emerging markets underperforming the U.S. This is back to where we've been for the last decade. What happened? This was supposed to be the year for international investing, and everyone who bet early on this is so far losing.
So, Bob, the #1 predictor for future performance of international stocks versus U.S. is what is the dollar going to do? And as you pointed out, the dollar in the first quarter, the dollar continued to drop dramatically, making a low around February. And that's why you had outperformance in the first quarter. But then you had a slight counter trend rally that happened in the second quarter. But if we look right now, the dollar is down over 10% off of its last September high. And then it's only up 1% off the lows here. And I think the other thing that people need to make sure that they keep in mind, you don't want to compare international markets to the S&P. Why? The S&P is a growth index. It's over 60% growth, where international is under 40% growth. The proper benchmark, we believe, to look at is value. Value in the U.S. trades at 15 times, where international trades at 13 times. So that's your true bogey. And if you look year to date and trailing 1 year, international has beat large cap value.
All right. We're going to talk a lot more about this, much more on buying protection strategies, including buffered ETFs. That's coming up on ETF Edge, 1:10 p.m. Eastern Time. Kim will be joined by Mike Akins, founding partner of ETF Action, as we discuss what's working and what's not working in ETFs this year. ETFedge.cnbc.com. Scott, back to you.